I would like to highlight the power of relative strengths. The power of relative strengths, identifying winning stocks and assets. Relative strength investing, is a strategy that involves selecting stocks or assets based on their performance relative to other investments. So, how does the asset performs, the returns it brings in compared to other related investments. The idea is to identify and invest in assets that have shown strong performance compared to their peers or a benchmark index with expectation that they will then continue to outperform. And if they continue to outperform, you would then end up doing very well. But if they don't continue to outperform, then that should be a disadvantage of this particular kind of investing, this particular investment strategy. So let's look at key features and of relative strength investing. What are the key features of this particular investment style? The characteristics therein. Number one is performance comparison. Performance comparison. It focuses on assets that have demonstrated strong relative performance compared to others in the same sector or in the same asset class or in in an index. So you pick securities that have performed that has kind of outperformed you know uh, other investments over time. Number two is momentum. Is momentum. It's often based on the principle of momentum investing, which assumes that assets that have performed well, will continue to perform very well. An asset that have like plummeted may continue to plummet, or at least they will remain that way in the near future. Number three is quantitative analysis. Quantitative analysis. So analyzes technical indicators or statistical measures to evaluate relative strength, such as price momentum, relative strength index, or the respective individual moving averages. Then of course you have the benefits of this strategy. What are the benefits of these investment strategies? Number one is identification of winners. So it helps in identifying and investing in assets that are showing strong performance trend. Generally, the idea is to invest in companies that have, had a kind of winning streaks of recent. So you identify winning assets, identify winners, and identify best performance in that sector or industry, and you invest in them. Number two is trend following. It leverages trend to potentially capture gains and rising gains in rising assets. So this strategy essentially, take advantages of upward movement or trends in the markets and capitalize on those trends to be able to gain or make money. Number three is diversification, which can lead to investment across various sectors or asset classes, depending on where relative strength is observed. That is it. So you can diversify, based on the expectation or the occurrence or the existence of relative strength in a particular stock compared to other stocks in the overall market. Let's highlight the risk of this relative strength investing. The first one here is momentum risks. Performance may not always continue as expected. Assets can experience reveals in current can reveal a kind of it can experience reversal or a kind of correction When an asset class gets too high, the market it will get corrected almost automatically because people will rush to sell the stock, and as they rush to sell, the price will plummet and take, and fall down to a more reasonable, a more reasonable price. Not only that, you have market timing. Market timing requires careful timing to enter and exit positions, which can be challenging and subject to market volatility. So it takes you being able to know precisely, what to buy, from which sector to buy, and when to buy. All these parameters will help you to obtain, you know, to buy at a reduced cost. And as you buy at a reduced cost, your profit is automatically met whenever the stocks increases in value. There's also number three, overemphasis on short-term performance. Overemphasis on short-term performance, which may lead to focusing on short-term gains rather than the long-term fundamentals. Let's look at examples of these strategies. Number one is a relative strength index, the popular relative strength index. Using the relative strength index to identify overbought or oversold conditions and make investment decisions based on the relative performance. You could harness this information and then you employ them in the acquisition of your shares or other investing. And not only that, you have momentum funds, investing in mutual funds or ETFs that focus on stock or assets with strong recent performance. And so the idea here is that you buy stocks that are racing towards their 52 weeks 2 weeks high, and then you discard the ones that are still at the bottom, or you don't buy these ones at the bottom. You buy the ones that are on an upward trajectory, through momentum fund. Number three is a sector rotation, shifting investments between sectors based on their relative strength indicators to capitalize on the strong potentials, of the performing sectors. Actually, is this suitable for the individual investor? Well, if you can raise the money, if you can raise the cash, it's suitable you invest indirectly. You can invest through a rate. Once you get your returns, regularly. So equally have a sector rotation, shifting investment between sectors based on relative strength indicators to capitalize on the strongest performing sector. So the very aim is for you to be able to equally rotate your investment across sectors. You want to obtain an outsized returns by eventually investing in a stronger performing sector, in the market.